So you want to own a car insurance company. Collect the premiums, put your name on a glass building, and watch the checks roll in every month like clockwork. But here's the strange part. Car insurance is one of the only businesses on earth that can lose money on every policy it sells, pay out more in claims than it ever collected in premiums, and still turn its owner into one of the richest people in America. It's a business where the product itself, the actual insurance, is frequently a money loser. And it's the business that built the single largest fortune in the history of American investing. By the end of this video, you'll understand how that's possible. How a car insurance company actually makes money, which is almost never the way people think. Why selling more policies can be the fastest way to go bankrupt. And why a car insurance company is barely an insurance company at all. It's an investment fund wearing a trench coat. Car insurance companies come in three sizes, and they're three completely different businesses. At the bottom is the small regional carrier, a startup writing what the industry calls non-standard auto. That's the polite name for high-risk drivers, people with accidents, tickets, gaps in coverage, or no credit history. On paper, the cost to get in is almost embarrassing. In a lot of states, the legal minimum capital to be licensed for motor vehicle insurance is only a few $1,000,000. Massachusetts sets the minimum for a motor vehicle insurer at around $1.5 million in capital and surplus combined. Michigan wants at least $7 million. That's it. That's the license. In the middle is the regional powerhouse, a carrier that dominates a handful of states, writes standard drivers, has real brand recognition, and holds hundreds of millions of dollars in reserves. Known by name in one region, invisible across the country. And then there's the national giant, State Farm, Progressive, GEICO, Allstate. These aren't companies, they're institutions. In 2024, Americans paid roughly $360 billion in private passenger auto premiums, and the top 5 carriers alone collected about 64% of it. State Farm sits at the top with close to 19% of the entire market. Progressive is right behind at about 17%. GEICO holds around 12%. Allstate around 10%. USAA around 6%. The three biggest names write nearly half of every auto policy in the country. But here's the first thing nobody warns you about. The license is cheap. The capital is not. That few $1,000,000 minimum is a legal floor, not a business plan. Under risk-based capital rules, regulators require you to hold enough surplus to survive your own worst year, and reinsurers demand even more before they'll back you. Here's the intuition. Insure just 20 cars worth $30,000 each, and if a hailstorm totals all of them on the same afternoon, you owe $600,000. To write real volume, you don't need a few $1,000,000 in the bank. You need tens or hundreds of millions sitting idle, waiting for a bad day that may never come. Then there's the part that works like geopolitics does for a casino. In casinos, one government decides who gets to play. In insurance, it's worse because there isn't one government. There are 51 of them. Every state has its own insurance commissioner, its own rules, its own approval process. And here's the trap that defines the entire industry. You cannot simply raise your prices. In most states, to increase your rates, you have to file the increase with the regulator and wait for permission. Sometimes for months. Sometimes they say no. That's the whole game. Your costs, car repairs, medical bills, lawsuits can spike overnight, but your ability to charge more is controlled by a government employee in each of 50 states. So where does the money actually come from? Here is the single most important idea in this video, and almost nobody outside the industry understands it. A casino makes money on the bet. Every spin, every hand, the math quietly skims a few cents, and over millions of bets that skim becomes a fortune. Car insurance is the mirror image. It very often makes no money on the bet at all. It makes its money on time. Here's the dumbest possible version. Imagine 1,000 drivers each hand you $100 in January. That's $100,000. And they tell you, sometime this year, some of us, we don't know who, will come back and ask you to pay over the year. Say you pay out $95,000 in claims and another $8,000 in salaries, offices, and advertising. You collected $100,000 and spent $103,000. On the insurance itself, you lost $3,000. And yet, for most of that year, you were sitting on tens of thousands of dollars of other people's money you hadn't paid out yet. The industry has a name for this pile. It's called float. And whatever you earn while you hold it, in bonds, in the stock market, that is yours to keep. Float is the answer. Your premium is not really a payment. It's an interest-free loan you didn't know you were making. An insurance company is, underneath everything, a bank that has convinced its depositors never to ask for the money back on any particular day. Now, one number tells you whether the insurance part won or lost. It's called the combined ratio, and once you understand it, you understand the whole business. Take everything the company paid out in claims, add everything it spent to run the business, and divide by the premiums it collected. Below 100, the insurance made a profit. Above 100, it lost money. A combined ratio of 95 means for every dollar you collected, you paid out 95 cents and kept a nickel. A combined ratio of 112 means you paid out $1.12 for every dollar collected. You lost 12 cents on the dollar before earning a single thing from investing. And here's the reveal that breaks people's brains. For years at a time, the entire auto insurance industry runs a combined ratio above 100 on purpose. In 2022, the personal auto industry's combined ratio hit about 112. In 2023, it was still around 105. The whole industry was losing money on the actual insurance and kept writing policies anyway. Why? Because, in Warren Buffett's own words, that underwriting loss is simply the rent the industry pays to hold the float. As long as what you earn investing the float beats what you lose on the policies, you win. You're being paid to hold a giant pile of other people's money. That's the secret. You don't get rich insuring cars. You get rich holding the money in between. So if the real product is the float, everything the company builds exists to do three things: get the float, keep the float, and stop it leaking out too fast. And that machinery is more sophisticated than anything a casino ever dreamed of. The first machine is pricing. A casino offers every player the same odds. An insurance company does the opposite. It tries to know something about you that you don't know about yourself. It builds actuarial tables from tens of millions of drivers using your age, your zip code, your car, your history, and in most states your credit-based insurance score, because how you manage money predicts how you file claims. And in the last decade it went further. Progressive's Snapshot, Allstate's DriveWise, State Farm's Drive Safe and Save. Little programs that watch how hard you brake, how fast you corner, and how many miles you actually drive. The pitch is a discount. The purpose is precision. The better they sort the safe driver from the risky one, the more safe ones they win and the fewer surprises they pay for. The second machine is retention, and it's the quiet one. Every year your policy renews automatically, and most people never shop around. The industry knows this. There's a practice regulators have been fighting called price optimization, or price walking, where a company charges its most loyal, least price-sensitive customers a little more each year, precisely because they've learned you won't leave. Inertia is an asset on the balance sheet. Every month you don't switch is another month they hold your float. The third machine is claims, and here's what most people get backwards. The claims department isn't the cost center. It's the product. It's the entire thing you paid for. But it's also where the money leaks, so enormous brainpower goes into managing what the industry calls severity, how much each accident actually costs, steering you toward preferred repair shops, deciding what's totaled, negotiating medical bills. A casino wants you to stay longer. An insurer wants your claim to close smaller. Put all three together and the entire revenue model fits in one sentence. Float. Times investment yield, times time, times how long they can keep you from leaving. Every single thing in the building exists to grow one of those four numbers. So with a guaranteed pile of other people's money, a machine to price it, a machine to keep it, and interest rates in your favor, why does anyone in this business ever lose money? Same answer as the casino. Everything else. Here's the cruelest fact in insurance, and it's the one that separates it from a casino completely. In a casino, the math is your friend and time is your weapon. Every second the customer plays, your edge grinds forward, and you know that edge to the decimal. In insurance, the math is a rumor you can't confirm for years. When you sell a policy today, you have no idea whether you priced it right. You won't know until the crashes happen, the lawsuits settle, and the medical bills arrive, sometimes 3, 4, 5 years later. The industry calls this the long tail. You're setting the price of a product before you know what it costs to make. You're guessing. And to cover those future claims you can't see yet, you have to set money aside right now. That pile is called reserves. Guess too high and you've locked up money you could have used. Guess too low and you've told the world you're profitable while you're actually bleeding, and the bill arrives later with it. Now stack on what you can't control. Inflation, which sends car parts and repair costs through the roof. Litigation, what the industry calls social inflation, where juries hand out larger awards and billboard lawyers advertise on every corner. Catastrophes, where one hailstorm damages tens of thousands of insured cars in an afternoon. And the market itself because the float is invested. In a year when stocks and bonds both fall, the one engine meant to save you is also on fire. Want to see it all hit at once? Look at 2022. Inflation spiked to the highest level in 40 years. Used car prices, repair costs, and medical costs all exploded together. And auto insurers who'd set their prices a year earlier for a calmer world got buried. State Farm, the largest and one of the most conservative auto insurers in America, lost $13.4 billion on auto insurance in a single year. Read the numbers slowly. Their auto business collected $45.7 billion in premiums and paid out $48.4 billion in claims costs alone before spending a dollar running the company. They lost money insuring vehicles before covering a penny of overhead. Their own chief executive put it plainly. They missed severity badly. They did not anticipate the inflation. The largest, best capitalized auto insurer in the country, wrong for 1 year, $13 billion in the hole. The float gives you a reliable engine. Everything bolted on top of it is a knife fight, and the knife fight is where owners lose. It has a small set of repeat patterns. Almost every auto insurance disaster comes down to one of two mistakes. Mistake number one: growth. In most businesses, growth is the goal. In insurance, it's the most dangerous word there is. Because growing fast usually means one thing: you're cheaper than everyone else. And there are only two reasons to be the cheapest carrier in the market. Either you're a genius who knows something your competitors don't, or you're underpricing risk and haven't found out yet. Thanks to the long tail, you won't know which for years, and by then you've signed up hundreds of thousands of underpriced customers. The clearest modern example is Root Insurance. Root launched as the shiny InsurTech disruptor, an app that would track your driving and price you perfectly. It grew fast and went public. Then the numbers came out. In 2022, Root's combined ratio on personal auto reached about 195. For every dollar it collected, it paid out nearly $2. It lost about $298 million that year. In 2023, it improved, but its combined ratio was still around 133, and it lost another $147 million. It didn't post its first profitable quarter until 2024. Years and hundreds of millions of dollars in losses, just to reach the point where the insurance stopped bleeding. That's the growth trap. If you're going to grow fast in this business, make sure you're a genius and not a corpse who hasn't heard the news yet. Mistake number two: not knowing your own costs. This is the long tail biting back. It's under-reserving, telling the world and yourself that you're profitable, paying dividends and bonuses on paper, while the true cost of policies you already sold quietly grows in the dark. Years later, the claims come in higher than you set aside. You have to top up your reserves all at once, and a company that looked healthy is suddenly insolvent. The history of insurance is a graveyard of carriers that grew fast, looked brilliant for a few years, and learned too late they'd been selling dollars for 90 cents the whole time. If you're building a company on promises you'll pay off in 5 years, you'd better be honest about what those promises cost. Almost nobody is. Step back, because the economics here are genuinely paradoxical. A car insurance company has one of the most reliable money engines ever invented: the float. Millions of people hand it money today for a promise tomorrow, and in the meantime it invests that river of cash, at scale, for free, sometimes getting paid to hold it. There's almost nothing else like it in business. It's Warren Buffett's favorite machine on the planet, and he built an empire on it. And yet operators lose billions, get downgraded, and go bankrupt with a regularity that would embarrass a normal industry. Why? Because the engine only works if you survive the thing bolted to it: the underwriting. And the underwriting is a guessing game with a 3-year delay, played against inflation, juries, hailstorms, and 50 regulators who control your prices. The float is patient. Claims are not. The whole business is one trade, over and over, a reliable capital engine against an unforgiving operating business. Survive that operating business for 20 years, keep your underwriting honest, and the float compounds into something almost obscene. So let's answer the question. If you do this right, how much do you make? 2 scenarios. Scenario 1. The small regional carrier. You raise $50 million in capital and write a focused book of business in a few states. In a good disciplined year, you might run a combined ratio of 96, a 4% underwriting margin, and earn a few percent more on your invested float. On $200 million of premium, your total profit might land around $15 to $25 million. It's not glamorous. It's regional, unsexy, and one bad reserve year can erase 3 good ones. But run it cleanly for a decade, and you've built real, durable wealth. It's the most boring serious business in America. Scenario 2. The national giant. Here the gambling almost stops being the point. A top-tier carrier collects tens of billions of dollars in premium a year, and here's the fun fact most people miss. In a normal year, the underwriting profit is thin, sometimes a loss. The real prize is the float. A giant like this can sit on tens of billions of dollars of other people's money, invested across bonds, stocks, and whole companies. When interest rates rise, that float alone can throw off billions of dollars in investment income a year. No new customers required. A modern auto insurer is barely an insurance company. It's an enormous investment portfolio that uses car insurance to gather the money to invest. Insurance is the loss leader. The float is the business. And if you survive long enough and stay honest long enough, you become something very specific. In 1936, a company was founded to sell auto insurance directly to government employees, cutting out the agent. The Government Employees Insurance Company. You know it as GEICO. In 1996, Warren Buffett bought the whole thing for Berkshire Hathaway. Not because he loves car insurance, because GEICO is a float machine. It collects premiums from tens of millions of drivers, and Buffett gets to invest that river of cash into stocks and entire businesses. GEICO's share of the auto market climbed from around 2% decades ago to about 12% today, and the float it produced helped build a company that crossed $1 trillion in value. The insurance was never the point. The insurance was the straw. The float was the drink.